Hey everybody, it's Joey from Universal CPA Review. In this video, we're going to talk about qualified business income deductions. And we have to remember that there are 3 scenarios, 3 possible steps, and 1 ultimate QBI deduction that can be taken on the individual's tax return. But before we dive into it, I just want to quickly remind you to subscribe to our YouTube channel and join any of our Facebook study groups. And if you like what you see in this video and want to give Universal CPA Review's visual learning platform a try, feel free to utilize our free 14-day trial. And if you decide that this is a good fit for you long-term and want to commit to our program, feel free to apply discount code UNIVERSAL2021 at the checkout for 25% off any product. Alrighty, QBI, here we go.
Okay, let's talk about some QBI. We're talking about qualified business income. And this is a type of income that will be derived from flow-through entities. Okay, so this is going to consist of both qualified trade or business income, as well as income specified from a service, trade, or business. Okay, so QBI is a very new element to the TCJA Act, and it comes with a pretty incredible deduction referred to as this QBI deduction. Okay, but more importantly, what do you need to know for the exam? So we're going to go through 3 steps, 3 scenarios, 3 limitations, and ultimately 1 QBI deduction. Okay, so this new QBI deduction is something that is considered one of the bigger tax breaks for flow-through entities. So what we need to know is the fact that flow-through entities are basically all entities that are going to flow through and be taxed at the individual taxpayer level. Okay, so this is business income that is going to flow through to the individual taxpayer and be taxed on their Form 1040. All right, and ultimately that's a 20% deduction to this bottom line amount for this pass-through entity. Okay, so ordinary business income, which would be reduced by any of those ordinary business deductions that are earned by the flow-through entity. Okay, so this is the amount that is going to get subject to this 20% deduction. And remember, that's going to be passed on and taxed at the individual level, aka those sole proprietorships are also going to be included here. Okay, so this is not going to include C corporations. C corporations, as we said, are going to be those corporations that are taxed at both the entity level as well as at the individual level. So they're not going to be qualified as these flow-through entities, and they're not going to be qualified for the QBI deduction. Okay, so pros and cons when it comes to C corps, but we will get there when we get there. There are 2 types of entities that we need to know when it comes to calculating QBI. And those 2 types of entities are going to be referred to as qualified trade or business, aka QTBs, and we're also going to need to know about specified service trade or businesses, and those are referred to as SSTBs. Okay, so starting by thinking about who is an SSTB, these are more specific. So these types of services, as the name suggests, are more specialized. Could be things like healthcare, law, accounting, actuarial services, performing arts, consulting services. We also have financial services, investment management services, athletics. Okay, so these could be your favorite professional sports teams. They're definitely going to be specialized services as well. So when it comes to identifying these 2 types of entities, it's going to be important that we don't just understand the definition, right? Because we need to understand the differences in the overall calculations to this deduction. All right, there's going to be some nuances that make this a little bit different. So keep this in the back of your mind as we go through qualified business income deduction calculations. All right, whereas qualified trader businesses are essentially going to be anything that is not a specialized service trader business, all right? A little bit vague, but that's why we say let's start by understanding what is an SSTB. Okay, because long story short, this is anybody that is not an SSTB. Okay, so slightly different rules here, and we're going to break out each of these rules for calculating this deduction step by step. So there's going to be a few different scenarios that we need to discuss, which is ultimately going to impact the overall deduction that will be allowed. Okay, so as we go through this is going to feel very taxy, right? This is one of those reg topics that might seem very tax calculation intensive. So we got to simplify that. And how are we going to do that? We're going to build that mental map. Okay, so this is going to feel a little bit gross, but bear with me. Okay, so let's go through this by including an example. So we can also eventually use this example as a memory aid. Alrighty, so let's visualize success. And we're going to meet the company Less is More. So Less is More is a space optimization company. Okay, so they're going to come in and clear up all your clutter, right? You know those people that just for whatever reason won't get rid of things. Okay, so I'm not going to point any fingers, but I think we all know who those people are. The way I see it, a lot of people can use less is more ink in their lives. Okay, but more importantly, when you think of less is more, you're going to remember that the less money you make, the more the IRS will allow as a deduction. And that makes sense, right? The less money you make, the more they're going to allow. The more money you make, on the other hand, the less the deduction they're going to allow. Okay, so less is more is also more is less, right? Think about it. Okay, so this is going to make a lot more sense when we go through our calculations one by one. Okay, but let's start by understanding what qualified business income is and what it is not. Okay, so qualified business income will consist of ordinary business income less ordinary deductions from this entity. So this is going to be all the revenue items less anything that comes from their ordinary course of business expenses, right? This is less is more Inc. sales, less all of the charges that they have incurred for their expenses to run the business. Okay, what's an ordinary expense again? That's going to be business expenses that are necessary for running the business. Okay, so again, this is ordinary business income, which is going to include revenue. What it is not going to include is going to be things like wages from paying the company's owners. If you pay yourself, that is still going to be included within that ordinary business income amount. Same with guaranteed payments, right? You're paying a partner. This is money that's going to be included in the taxpayer's taxable income anyway. All right, so what is it not going to include? It's not going to include portfolio income, which could be things like dividend income or interest income. It's not going to include additional gains, such as capital gains, right? That's not revenue. That's not money coming in from more or less Inc.'s ordinary course of business sales. That's additional income from the gains of an investment. Okay, so you got to know specifically what is QBI? What's it going to exclude? And it's pretty intuitive when you think about it. Okay, so assuming that the owner who's receiving qualified business income from more or less Inc. is going to keep their taxable income under a specific threshold, then they're going to be allowed by the IRS to take a 20% deduction. Okay, and that's a fantastic deduction for small business owners. Okay, so 20% just for qualifying as this qualified business is huge. Okay, but not so fast. The IRS is going to have limitations. Okay, not everybody could take this deduction. And as we said, the more money you make, the less you could take. Okay, and the less money you make, the more you could take. Less is more. Alrighty, and at the end of the day, we're going to focus on these thresholds. And we're ultimately going to have 3 scenarios, 3 steps, 3 limitations, and 1 ultimate QBI deduction. Okay, so once again, let's pull out that mental map. We have 3 big ticket items that we got to remember in our mental map. Right? We got to remember our 3 scenarios, we got to remember our 3 steps, our 3 limitations, and our 1 ultimate QBI deduction. So we're going to focus primarily on how less is more Inc. will be allowed to take this ultimate deduction. But that's the whole name of the game, all right? We're going to be figuring out how much they could take as a deduction for calculating their taxable income. Okay, and the reality is that it depends on how much money the company made in qualified business income. So let's start by talking about the phase-out ranges. Right, when you think about this range, don't get too caught up in the Internal Revenue Code and how they're always going to be changing these numbers, okay? I just want you to remember the rules for these calculations, not necessarily memorizing a bunch of range numbers. Okay, so we're not working in the Stone Ages anymore. We could look this stuff up. All right, but here are the ranges for the current year. If the taxpayer is single, they have this $50,000 range, right? If they're married, they're going to have this $100,000 range. Okay, so what those ranges mean yet, we'll get back to. So easy to pinpoint that the range gap doubles if the taxpayer is married from $50K to $100K. And looking at these ranges is ultimately going to guide us in the scenario that the taxpayer is going to fall within. So let's start with scenario number 1. And a little trick to make our life a little bit easier is to think of scenario number 1 as the we made too little money scenario. And for each scenario, we're also going to add an additional step to this calculation. Okay, the CPA exam is hard enough as it is. Let's simplify as much as we can. All right, so we're going to determine which scenario that is going to be applied by focusing on 2 things: the amount of taxable income and the filing status of the taxpayer. Okay, so if the taxpayer is single and they have less taxable income than this lower range amount, and if they are married, their taxable income would be less than this lower range amount. right? If their taxable income is less than these lower range amounts for each respective situation, then they're going to fall within the we made too little money scenario. So what we're saying is that the taxpayer has qualified business income. Sure, we identified that. But we must remember that less is more. So the lower the income, the more they're going to be allowed a deduction, which is a good thing for tax purposes. So the 20% deduction stays intact, but it will always be subject to this first limitation, no matter how much money they made. So limitation number 1 is always going to limit the deduction that the taxpayer could take as the lesser of 20% of qualified business income or 20% of taxable income before the QBI deduction minus any capital gains. Okay, so as you go through this with repetition, this is going to feel like second nature, I promise. So let's go through a quick example for scenario number 1. All right, Johnny boy, a single taxpayer is the owner of Less is More Inc., a qualified trader business. Okay, so John has taxable income in the current year in the amount of $125,000. So John had the following additional income. John had portfolio income of $10,000, qualified business income of $110,000, wages of $60,000, qualified tangible property $180,000, and we want to determine John's QBI deduction. Okay, so the first thing we need to identify is the filing status of the taxpayer. All right, we know that they're a single filing taxpayer. Okay, now we need to determine how much is their taxable income, and we see that it's $125,000. So we know that this falls below the minimum range threshold for single filers. So now we can identify that John falls within the we made too little money scenario. Okay, so what that means is there's only going to be one additional step for calculating the QBI deduction. Okay, so John's going to be entitled to 20%, but 20% of what? 20% of the lesser of the QBI, qualified business income, or 20% of taxable income less any capital gains. All right, well, we know that the qualified business income is $110,000. It tells us right here in the information. All right, we know that taxable income is $125,000. All right, it doesn't specifically say capital gains anywhere, so we're just going to have $125,000. So what is the lesser of the two? Obviously $110,000. So $110,000 times 20% is going to give us $22,000, and this is John's QBI deduction. Now, keep in mind, for scenario number 1, these rules are going to be the exact same for both QTBs and SSTBs. Right, this same first limitation is still going to be applied even if John was the owner of a specialized service trader business. Okay, so taking a look at this quick example, John and Susan are married filing jointly, and they are the owners of Less is More Inc., right? Maybe John got married. All right, but now this is going to be considered a specialized service trader business. Okay, this is an SSTB. And their taxable income for the current year was $300,000. They had portfolio income of $45,000, qualified business income of $280,000, wages of $60,000, and qualified tangible property of $180,000. So let's determine the QBI deduction. Okay, so step 1, are they married or are they single? Obviously, they're married. Step 2, what scenario do they fall within? Well, they made less money for a married couple than the lower range limitation. So they fall within the we made too little money scenario. Okay, so scenario number 1 again. So we're going to be comparing 20% of qualified business income and 20% of taxable income less any capital gains. And we're going to take the lesser of the two. So 20% of qualified business income is 20% of $255,000. 20% of taxable income, which is $300,000 less the capital gains that don't exist, would tell us that the QBI deduction would be calculated as the lesser of the two, right? $255,000 is less than the $300,000 amount, which means that the QBI deduction is $255,000 times 20%, and therefore their QBI deduction would be $51,000. Right, notice scenario number 1 does not change regardless of whether this is a QTB or an SSTB. Okay, scenario number 2, but also we remember that we now have an additional step, right? Each scenario we're going to add a step. So this is what we referred to as our we made too much money scenario. Okay, so keep in mind, we're only going to be focused on QTBs here under this scenario. Okay, we're going to be disregarding SSTBs. Okay, so now we're focused on our upper ranges
for our single and married taxable income thresholds. And we're going to remember that less is more, right? We got to get rid of all that clutter. So the taxpayer made too much money, meaning they're single, and that means their taxable income exceeded this upper range amount. And if they're married, then their taxable income would have exceeded this upper range amount. So we also remember that for each scenario, we're going to add a step. Okay, so if the taxpayer has taxable income that exceeds these amounts, right, we're going to start with the 20% that the taxpayer normally would have had the right to take, right? They're sitting there, they're getting really excited, they get to take this 20% deduction. But then the IRS is going to come back and say, hold up, wait a minute, you made too much money. Okay, so the 20% that you were originally allowed to take, yeah, we're going to go ahead and limit this to a less amount because less is more, right? But also more is less. That means the taxpayer made too much money, so they're going to be allowed to take less of a deduction. Okay, so the first step, we're going to take the 20% QBI deduction, which is going to still be limited to the lesser of 20% of QBI or 20% of taxable income less capital gains. Okay, so step one will always be the first limitation, but only for QTBs under this scenario. Okay, because no deduction will be allowed if they made too much money and they were an SSTB. All right, so they're done. If they're an SSTB, no deduction whatsoever. Okay, the IRS is going to take one look at how much money they made and they're going to say no QBI deduction for you. Okay, and assuming they made too much money. Right, whereas if less is more is this QTB and the taxpayer falls within this we made too much money category, then they will have a shot at still taking a deduction. All right, so let's zero in on this. Okay, so step one is taking the lesser of this 20% of QBI versus this 20% of taxable income minus capital gains. All right, they're already getting limited, but the IRS is now saying you made too much money, so we're going to limit this even more. Okay, so they're going to take this tentative deduction calculated in step one, and then they're going to limit it again to the greater of 50% of the combined W-2 wages for the business, or 25% of W-2 wages for the business, plus 2.5% of the unadjusted basis immediately after the acquisition of all qualified tangible property. What in God's name does that mean? Basically, we're just saying 50% of all the W-2 wages, or 25% of the W-2 wages, plus 2.5% of property, plant, and equipment. Okay, so anytime you see the value of PP&E within this scenario, we're just going to be taking that 2.5% of that value. Okay, and again, if the question said that this was an SSTB and they made too much money, then the deduction would always be zero. Okay, so let's look at this fact pattern. We have net taxable income of $450,000, qualified business income of $200,000. We see that they have long-term capital gains of $200,000, QTB wages of $70,000, and QTB qualified property of $200,000. Okay, they might refer to the QBI deduction as a Section 199A QBI deduction, all right? That's just the section within the Internal Revenue Code. All right, but what do we know? We know that this exceeds the upper range limitation. Okay, so what that means is they're going to fall within the we made too much money scenario. Okay, and we know that because we see that the taxpayers are married filing joint. All right, and the taxable income amount is greater than that upper limitation. Okay, boom. Now we know that this is going to be scenario number 2. So that means we have 2 steps. Step 1 is determining limitation number 1, which is going to be the QBI deduction being the lesser of 20% of the combined QBI of the taxpayer, or 20% of the taxable income amount less capital gains. All right, so 20% of QBI is 20% of $200,000. Okay, so that's going to be $40,000 tentatively. All right, we know that taxable income is going to be $450,000, but they also have these capital gains of $200,000. So less the capital gains of $200,000 gives them a total taxable income less capital gains of $250,000. $250,000 is greater than $200,000. Okay, so we're going to take the 20% of $200,000, not 20% of $250,000. Okay, so that's step 1. Our tentative deduction is going to be $40,000, which is going to be the tentative amount that flows right into step 2. Right, the taxpayers made too much money, so the IRS is going to say, we're going to limit this even more. And that next limitation is going to be the greater of 50% of the combined W-2 wages for the business, or 25% of the W-2 wages, plus 2.5% of the tangible property.
All right, so do they have wages? Yes, they do. There's $70,000 worth of wages. Does the QTB have qualified property? Yes, it does. So we have the information we need. 50% of the QTB's wages is going to be $35,000, right? 70,000 times 50%. That's being compared again to 25% of 70,000 plus an additional 2.5% times 200,000. So what is the greater of the two? Well, we're comparing 35,000 to the sum of 17,500 plus 5,000, which is 22,500. Okay, so the greater of the two is 35,000. That is going to be the taxpayer's qualified business income deduction, right? Notice 35,000 is less than the original tentative deduction of 40,000. Less is more, but also more is less. Okay, so because they made more money, they're going to have less of a deduction. And if this instead was an SSTB, right, a specialized service trader business, the qualified business income deduction would always be zero. No QBI deduction if they fall within the we made too much money scenario. Right, not only is the IRS saying, yeah, you made too much money, but they're also saying you are an SSTB, so we're going to give you nothing. Okay, so now we're talking about step 3 in our mental map, and this is scenario 3. And as we mentioned, for every scenario, we're going to add an additional step. Okay, so this is a scenario where the taxpayer didn't make too much money, they didn't make too little amount of money, they made an in-between amount of money. Okay, so their taxable income falls between these two ranges if they are either single or this range if they are married. Okay, but as we remember, after step 1, if they exceed this lower limit, that deduction would be limited even further. But it wouldn't make sense to limit this again if they didn't make even more money than had they exceeded this upper range threshold. So we're not necessarily going to limit this or bring this down even further. But we are going to use the difference between these two limitations, assuming scenario 1, and the limitation assuming scenario 2. So that's why it's important that we calculate these before calculating the deduction under this third scenario. Okay, so we're going to take a look at this formula here, and it might seem a little bit crazy, but we're going to take this step by step, and it might make this calculation a little bit more intuitive for you. Okay, so think of this as your roadmap to attacking scenario number 3, which doesn't make particular sense, I will be honest, but if you think about it as you calculate it, it might become a little bit more clear. And what can I say? We got to know it. Okay, so what we're going to do is take the taxable income amount before the QBI deduction, and we're first going to reduce it by the lower threshold amount within our range. And what we're going to do next is take this calculated amount and divide it by the phase-in range, right? Meaning if the taxpayer is single, we're going to be dividing it by 50,000, and if the taxpayer is married, we're going to be dividing it by 100,000, okay? Easy peasy. So now we have this percentage. What are we going to do with it? We're going to take that percentage and we're going to now multiply this by the difference between what we calculated in step 1, right, that first 20% limitation, and what we calculated in step 2, that second limitation. So once we have multiplied that percentage by the difference, what we're going to do with that is now reduce that 20% QBI deduction by this amount. And what you'll find is this will always be less than what we calculated under limitation 2 in the we made too much money scenario. We have a similar scenario, but only now as we see our taxable income amount falls within our range. Right, assuming these taxpayers are married, we also don't see any capital gain. Okay, so step 1 becomes very straightforward. We're taking 20% of 370,000 and comparing it to 20% of 200,000. So the lesser of the two is going to remain the same. Okay, so step 2, we're now going to determine the greater of 50% of W-2 wages or 25% of W-2 wages plus 2.5% of tangible property. Okay, so same result here. Nothing is changing. We're limiting this once again to 35,000. So now we can enter step 3, and we're going to have many steps within this. Okay, so step 3.1 is taking the taxpayer's taxable income before QBI, which in this case is $370,000. We're going to reduce this by the minimum threshold for married filers. Okay, and that's going to give us this amount that we will now divide by the range for married filers, which is 100,000. Okay, so this percentage is now going to be multiplied by the difference between step 1 and step 2, which is the difference between 40,000 and 35,000. So we're now going to take this $5,000 amount and we're going to multiply it by this percentage that we calculated. All right, so this is now going to become what we reduce the 20% QBI deduction by. Okay, and as you can see, this is a lesser limitation than had we just rolled right into step 2. Okay, so had we taken the deduction under the we made too much money scenario, then this limitation would be even more. Okay, so less of a limitation, which naturally makes sense. All right, I know that this is a lot to absorb, but break this down and give yourself this roadmap and try to understand intuitively why we're doing this.